Many people choose to invest in bonds for the stability they can provide, with generally better returns than cash but at lower risk than stocks and shares. And in this video, I'm going to look at some of the best Vanguard bond funds that you might want to consider for inclusion in your own investment portfolio. In doing so, I will go through statistics such as fees, performance, fundamentals, and the specific risks that can affect each fund. None of the funds featured are my recommendations, and this video is not to be construed as financial advice and is for educational purposes only. Please fact check what anyone tells you on YouTube, including what I say. Do your own research into what might suit your individual circumstances best, and consider seeking advice from a suitably qualified professional if unsure. I've put chapter markers on the timeline and in the description below to help you navigate to where you want to get in the video. So let's jump straight in by firstly covering what bonds are and how they work. Bonds are fixed income investments where investors lend money to entities such as governments and corporations. This is in exchange for regular interest payments or coupons and the return of their money at full at maturity. And a bond is like lending your friend money in return for an IOU. Imagine you give them £100 today and they promise to pay you back in 5 years. In the meantime, they agree to pay you £5 every year as a thank you for the loan. At the end of the 5 years, they then repay the £100 in full. So in this scenario, you're the investor, your friend is a bond issuer, which would be a government or corporation. The annual £5 is the coupon or the interest payment. The £100 paid back after 5 years is the principal, with the end of 5 years being the maturity or redemption date. So now we know a little bit about how bonds work. Let's consider why investors choose bonds. And there are many reasons. For one, investors like the predictable income stream that's provided by the regular interest or coupon payments. That generally provides better returns than with cash savings. And when you invest in bonds and hold them to maturity, you have the reassurance of hopefully getting a full principal amount back, so you can plan and you know exactly what you're getting. Government bonds, such as UK gilts or US treasuries, are regarded as some of the safest, backed by the government's ability to tax or print money to pay off their debts. While stocks can have significant price swings due to market volatility, bonds usually experience more stable price movements. During economic uncertainty or market downturns, bonds, especially high-grade government bonds, tend to attract investors, helping to preserve wealth and raise value. And bonds are rated by credit agencies, providing guidance to investors on the issuer's likelihood to repay. And investors will also include bonds in their portfolios for risk management reasons. The modern portfolio theory is a financial model introduced by Harry Markovich in 1952 to optimize portfolios by balancing risk and return through diversification. The theory encourages the inclusion of a mix of assets, for example stocks, bonds, real estate and commodities, that come with different levels of risk and return. By diversifying this way, investors reduce their overall risk, as the poor performance of one asset may then be offset by the better performance of another. The relationship between such assets might then be described as having negative correlation, which is generally the case regarding the relationship between equities and bonds. If you consider a seesaw, when one side goes up, the other tends to go down. Imagine stocks sitting on one end and bonds on the other. As the stock market climbs, bond prices often dip, and when stocks fall, bonds usually rise, providing balance to your portfolio playground. An example of this would be during the 2008 financial crisis. Global stock markets plummeted, but many government bonds performed well, offering a safety net to diversified portfolios. So adding bonds to equity portfolios can therefore be a powerful diversification tool to help you manage risk. By combining the two, you strike a balance. Equities drive growth, while bonds act as a safety net through times of turbulence. There are differences between bonds and bond funds or ETFs. For one, bond funds provide easier access to the asset for retail investors than with the purchase of individual bonds. But one of the main differences between the two is that you have less control with bond funds, in that there's no redemption date and bond funds don't mature, as they continually purchase new bonds to replace the old ones that are maturing. So you cannot necessarily plan for the return of your principal at the maturity date like you can with individual bonds. Which takes me nicely onto risks. We've talked about why investors like bonds, but with all that being said, bonds are not risk-free and they will be affected by certain market conditions. When interest rates rise, bond prices typically fall. This is because new bonds are issued with higher yields, thus making existing bonds with those lower yields less attractive to investors. Conversely, when interest rates fall, bond prices will rise. And higher inflation will erode the purchasing power of bond interest payments, leading to lower bond prices, and bonds tend to perform better in a low inflation environment. In strong economies, riskier assets such as equities may be preferred, leading to lower bond demand and prices. If the credit risk increases, then bond prices may decrease. A bond rating is an assessment of the creditworthiness of the bond's issuer. It's a prediction of the likelihood that a company or government or another entity will default on the debt obligation, and bonds are rated by one of the three credit agencies that grade them according to their own varying scales between AAA to D, for instance. The ratings are then used by investors to judge the riskiness of a bond investment, but it will also influence the return of the bond. A lower rating requires a higher return on the bond to compensate for the added risk the investor is taking on. Central banks' decisions on interest rates, quantitative easing or quantitative tightening directly impact the prices of bonds, and the amount of government borrowing or debt may push up bond prices as the credit risk increases. Bonds with lower credit ratings, longer maturities, or those issued by smaller entities tend to have less liquidity than those higher rated government or corporate bonds. Movement in currency exchange rates can adversely affect the value of your investment, and currency hedging or currency denomination may be used, but this is not a guarantee against that risk. And potentially the biggest risk of all is duration. If your bond fund consists of bonds of shorter duration, it will not be considered as very risky at all. And if very short, it will be considered as cash-like. And the safest fund of all would be a money market fund, which consists of very short-dated securities. But if the bond fund or ETF contains longer duration bonds, it will be more susceptible to many of the risks we have mentioned, but especially to inflation and interest rate changes, which are more likely to move more unpredictably over longer periods. The illustration shows how much more volatile a 15-plus year duration gilt ETF is when compared to an ETF that only includes gilts of less than 5 years. Which is why when you invest in bonds of longer duration, in normal market conditions, you should be compensated with a higher reward or yield for taking on the additional risk. The current US Treasury yield curve shows how you only really start to get compensated for duration when reaching a much longer period. And even then, it's not that significant when compared with lower risk treasuries with a duration of less than a month. And duration should be one of your biggest considerations when looking to invest in a bond or bond fund. So that's hopefully giving you a quick tour of what bonds are and how they work. Let's now apply that information to the Vanguard Bond Funds that are featured in this video. But before we move on, I would really appreciate it if you're enjoying this video to hit the like button, consider subscribing to my channel, and to turn on your notifications so that you'll be aware of when I post new content. The first fund is one of the most popular, which is the Vanguard Global Aggregate Bond Fund UCITS ETF, with the ticker of VAGS if you go for accumulation version, and VAGP if you choose income distribution. All of the funds featured today come as either an accumulation or distribution version. Choose accumulation if you want the most maintenance-free option to grow your wealth, as accumulation funds automatically reinvest income generated, for example from interest or coupon payments. If you choose a distributed version, you get paid the income directly and it's not reinvested for you. You might prefer the income distribution version if you want regular income from your investments and are not necessarily prioritising growth. All the funds featured have low-cost total expense ratios or ongoing charge figures. This is the cost of fund administration, and the aim is to try and keep these costs to a minimum so that you can keep more of your investments. And the OCF for this one is a reasonably low 0.1%. The fund is sterling hedged, removing some of the currency risk as the fund's basic currency is the US dollar. It's also traded through the London Stock Exchange to further minimise forex fees. In my opinion, it's always better to keep funds or ETFs in your own currency and traded on your own country's stock exchange, as a cheaper alternative to having to pay your investment platform or broker more expensive foreign exchange fees for having to do this currency conversion manually. This fund has 11,556 bonds of different durations, with total assets of over 114 million. The fund is passive, meaning that it just tries to replicate the performance of the index it tracks, with no attempt to beat it through active management that would come at additional fund cost and risk. It tracks the Bloomberg Global Aggregate Float Adjusted and Scaled Index. This is a widely recognised benchmark designed to reflect the characteristics of the global bond market, including emerging markets. Over 60% of the bonds are government bonds, and all have investment grade ratings of at least BBB. And BBB should be your minimum requirement if you're looking to invest in good quality credit. The duration of about 43% of the bonds are under 5 years and 33% between 5 and 10, with the remainder being longer. An effective duration, the average collective duration of bonds in a global fund, is typically between 6 and 8 years, and that's the same with this one. Looking at performance going back 5 years, for the last 2 years it is reasonable, but high inflation and rising interest rates were contributing factors to poor returns back in 2020 through to 2023. Prior to 2022, we were in a position of very low interest rates, which is reflected in the returns in the earlier years. And past performance should not be used as a reliable indicator of what happens in the future, and in any case, we know that bonds are not going to set the world alight with amazing returns. So there's no real comparison here with the returns of bonds and those of growth equity funds. You will probably be looking to include bonds in your portfolio for reasons of stability, reliability and diversity, rather than for reasons of growth that you will seek to get from the equity side of your portfolio. Although global bond funds are diverse, you will take on some duration risk from the effective duration of the fund and how much interest rates and inflation could change to influence the price over this period. And although all bonds in this fund are investment grade BBB or more, the fund also includes bonds from emerging market governments and entities. So credit risk is a little bit higher than it would be if it was totally government backed from the developed world. And the next bond fund featured demonstrates how you'd expect higher yields and returns as compensation for the greater credit risk that you endure with this one. And is a passively managed US dollar, emerging markets government bond UCITS ETF, the accumulation version being VEMA and VEMT being the distribution. And the OCF for this one is a higher but still reasonable 0.25%. When dealing with emerging markets, assets tend to be less liquid and more expensive to trade in more fragmented markets. That then pushes the fund's administrative costs up. With this one, the fund is traded in US dollars on the London Stock Exchange, so you take on a bit of additional currency risk here. It's smaller than the last with 1,355 bonds, with total assets of over 611 million. It tracks the Bloomberg Emerging Markets US Dollar Sovereign Plus Quasi-Sov Index, and it's 100% government-backed bonds. About 38% of these are considered to be lower grade under BBB, also known as high yield or junk bonds. The duration of about 37% of the bonds are under 5 years and 30% are between 5 to 10 years, with the remainder being longer. Looking at performance going back 5 years, for the last two, it is very reasonable, with the rise in interest and inflation troubles impacting less in 2022 to 2023. As with the last fund featured, you do take on some duration risk here, given that the effective duration is similar. But credit risk would be the main factor here, with less stable emerging market government issuers, and with there being non-investment grade bonds included. Here, the expectation is that you get a better return as compensation for taking on more risk. But when doing your research and deciding what's best for you, don't lose sight of why you're including bonds in your portfolio in the first place, as this one, although providing you with that asset diversity, might not provide you with the stability that you want, with that heightened credit risk and potentially increased volatility. The next passive ETF we will look at, with its greener credentials, moves away from government-backed credit and is ESG Global Corporate Bond UCITS ETF, accumulation version V3GS, distribution V3GP. And the ongoing charge for this one is 0.15%. This fund is sterling hedged and traded on the London Stock Exchange and includes 5,133 bonds, total assets of over 85 million. It tracks the Bloomberg MSCI Global Corporate Float Adjusted Liquid Bond Screened Index, which includes investment-grade corporate fixed-rate bonds from both developed and emerging market issuers, which are screened for certain environmental, social, and corporate governance criteria by the sponsor of the index. You will need to dive further into the criteria of this one, as all ESG funds have different measurements and targets, which may not match with your ESG credentials and principles. This is just about 100% corporate, so there might be slightly higher liquidity risk here than with government bonds, but all are investment grade of at least BBB. Similar to the Global Aggregate Bond Fund that was featured earlier, this bond's effective duration is almost the same. Only 3 years performance data exists. However, when looking at the most recent two, this one has fared better than the first fund. I find that when researching funds and ETFs, ESG versions often offer more value than their non-ESG counterparts, and this one seems to be no exception. Like the previous funds featured, you do take on some duration risk here, given the effective duration of the fund, making it more susceptible to interest rates and inflation movements. And although all of the assets included are BBB and deemed investment grade, the fund consists of corporate bonds, including those from emerging markets, where they might be subject to additional geopolitical volatility. So credit and liquidity risk might be things to look out for. With this last passive fund, much of the duration risk gets removed through its sole selection of short-dated global bonds, and it is the Vanguard Global Short-Term Bond Index Fund. The accumulation version is VGSTBGA, distribution VGSTBGI. This is a mutual fund and not an ETF. It's very similar in that it pools together investor money to buy shares on scale. Whereas ETFs are traded on the stock exchange, a mutual fund is traded through a fund manager once per trading day and not instantaneously throughout. But the most important consideration, in my opinion, is where you can purchase them, which is more limited and generally confined to brokers or investment platforms that charge a platform or custody fee. The platform fee, along with the ongoing charge figure for the fund, are probably two of the biggest costs that you will encounter when investing in funds or ETFs. This one is available on the Vanguard platform, but not available on Trading 212 or Invest Engine, who only trade ETFs and don't levy any platform fees for holding them. And the OCF for this one is a competitive 0.15%, and the fund is sterling hedged. It has 5,267 bonds within and total assets of 1.4 billion. It tracks the Bloomberg Global Aggregate ex-US MBS 1 to 5 year float adjusted and scaled index. This includes global government, corporate and securitized bonds with a maturity between 1 and 5 years, but specifically excludes US mortgage-backed securities. About 75% is government or government-related. All are investment grade of at least BBB. There's an even distribution across the shorter duration bonds of varying periods between 1 to 5 years, and this drastically reduces the fund's effective duration. The fund provided similar returns to the first fund that we featured, VAGS, but for less duration risk, demonstration that longer duration has not necessarily provided a higher risk premium over the last few years. This might change as interest rates fall and inflation continues to decline in the shorter term, but who knows what will happen in the longer term future. With good credit issuers, liquidity and less duration risk, on the face of it, this one seems to carry the least overall risk when compared with the others. But whether this shorter dated fund continues to get comparable yields for less risk in the longer term remains to be seen, and should be a consideration for you before making your decision. Remember that including bonds in your portfolio is about trying to maximise the returns you get for less risk by getting balance and diversity, and your choice should therefore not be wholly about performance, as the equity side of your portfolio should take responsibility for this. And if you are a younger investor, you might want to stay away from bonds for now, being that you will probably want to drive as much growth as you can through 100% equity portfolios. After all, if you cannot access your pension until retirement age, why would you worry about volatility in the shorter term? But if you are older, or more cautious in your approach to investing, you might feel that offsetting some of that growth for more stable and less volatile assets is a preferred journey to try and meet your objectives more gently. I do hope that this video has been useful and interesting, and once again thanks very much for watching.